Hello and welcome everyone to Oil Asset of the Day, presented by myself, Phil Carr, at the Gold and Silver Club. So what do you need to know as we go into a fresh week? So from a hedge fund point of view, we have seen hedge funds and money managers, they've increased their net long positions again in the latest week. In fact, on US oil, they've now built the largest net long position in over 3 months. And we definitely do continue to see support come in for oil around that 52 to 53 US dollar per barrel handle. However, you can see very clearly each time there is an escalation in trade war tensions between the US and China, this will very fast impact oil to the downside. So a lot of the rallies that we've seen over the latest week, we've seen those tend to fizzle out after an escalation in the recent narratives with the US and China, especially on Friday, of course, with China retaliating first of all in the morning against the US, putting more tariffs on US goods, and then vice versa. We've seen the rhetoric from Donald Trump and his Twitter updates later on in the session on Friday again have a negative impact as Donald Trump and the US have retaliated against Chinese tariffs. And we of course saw oil gap down on the open on Sunday through to Monday, but then found support again. So what that tells you right now with oil is at the moment it tends to be much more of a short-term trading market. There are definitely opportunities to be had by trading that short-term range. I am looking at resistance this week of coming in around 55 US dollars per barrel, and then support back at the lower end of the range around 52 US dollars per barrel. We are looking at the API data on Tuesday and Wednesday's oil inventories as well, where we're expecting a drawdown of 2.1 million barrels. We're going to be looking out for that data to see if it is a catalyst for a potential move higher midweek on oil. But certainly what we're looking at the moment is of course that buying evidence at the lower end of the range for opportunities to buy in right around that 50 to 52 US dollar per barrel level. At the moment we're not seeing closes below $52 per barrel, and that does tend to be very supportive, but at the same time oil has been unable to break above overhead resistance, which resides this week around 55. Last week we mentioned that we were looking for oil prices to fall lower, finding resistance around 56 to 57 and then a move back down towards 53. That's exactly what we saw later on the week. A lot of that of course happened on Friday, and several of you have messaged in as well that you took note of that particular analysis and therefore you were able to bank your profits ahead of those narratives on Friday, where we did see an escalation in trade tensions, where many of you have booked your profits or certainly protected your trades and actually took advantage of the sell-off as well, because we did see quite a significant decline on Friday, then a gap up of course earlier in the week as well. So really the key points that I would look at this week is we're looking at a range of our market, resistance around 55, support around 52, but of course any escalation in trade war tensions between the US and China can of course very quickly cause sell-offs on oil, and the same can be true for any potential deals as well, as we start to see negotiations and more favourable narratives between US and China come out over the last 24 hours. That is providing support for oil. Bear in mind that hedge funds have increased their net longs to the highest level in over 3 months. Normally, as we go into the month of September, it does tend to be also more supportive for oil prices. So I'm looking at limited downside at the moment, but we might come and retap the lower end of the channel. Then I'm looking for buying evidence around that 50 to 52 US dollar per barrel handle. So with that, that's been Oil Asset of the Day, and I wish you good trading.